Hello everyone and welcome to Inter's IR Talks. I'm Rafaela Vitória, Head of Investor Relations, and this videocast is produced by the IR team to bring valuable insights into our business. Each session we're going to bring an officer to talk about his perspectives and views to share with you. Today in this edition, I'm happy to have Santiago Stel. Hi Santi.
Hi Rafa, thanks for having me. Great to be here.
And we're going to talk about business strategy, efficiency, growth, and profitability. Santi, let's start with your background. Tell us a little bit about your background, how long you've been in Inter.
Excellent, great. So I started working in finance back in 2004 in Argentina for a Brazilian-owned bank. And as I was thinking on doing a master in finance for my graduate studies, I saw that the masters back there were mostly done by US-educated Wall Street professors, right, or Wall Street experienced professors. So what I thought is, if that's the highlight of those masters in finance, then I'd rather study what they studied, in the US, and have my experience in Wall Street. That was 2008 when the banks started to collapse. 2009, so I didn't know exactly where I was going to end up working, as the names of the banks were shrinking, the list of options. But I thought that a good education and that experience would pay off eventually. So I came to the US to study at Duke and then worked in Wall Street in IB for 11 years, helping Latin American banks and fintechs raise capital and do M&A. I had the fortune of working for Inter back in 2018. When we got the RFP in 2017, I started to find out and study the case of Inter, which was truly unique, a bank from Minas Gerais that came from being a local SME-focused, mortgage-focused bank to one of the largest global digital banks in the world. And then I stayed in very close contact with João Vitor and the team. And in 2022, exactly 3 years ago, I joined the team. And very happy to be here since. At the beginning, I was working in your role, in IR, for about a year. And the past 2 years as CFO. Great.
And the last 3 years, a lot has changed at Inter. Mostly, we launched our strategic plan, the 60-30-30. Tell us a little bit about the plan and where we are at this moment.
So the 60-30-30 was a plan that we designed with João Vitor and the team that was obviously approved by the board to have a financial target, 5-year long, by the end of 2027. We announced it in January of 2023 with the goal of having clear aspirational metrics that were achievable and compatible with the design of the digital banking model that was created by João Vitor and the team. So what we thought was we had to have a metric of growth, and that was clients, 60 million target clients by the end of 2027, 30% efficiency ratio, which is a metric of operational excellence and efficiency, obviously, and that should be part of the essence of the leverage capacity that the digital banking model has, and then 30% ROE, which is a metric of overall profitability. So combining growth with profitability, growth capturing the clients, operational excellence and efficiency, and the bottom line with the ROE. That was how we came up with the results. It's interesting to talk about the 60-30-30 today because it's almost exactly in the half of that 5-year journey. We did the first half. We are on target, a bit advanced in some metrics. Some people argue that the first half is the easiest one. I actually am on the camp of the toughest one being the first half, because the 0 to 1, breaking that inertia of profitability and getting the systems in place to have that network effect that we already have in place and it's playing out very nicely, makes us start the second half with very strong momentum. Obviously, this is just a 5-year plan. The company will continue for a very long time, but it's from a business perspective or financial goals perspective, it allows us to also communicate externally where we want it to go. The analyst converts a lot more towards a mean. Before it was a lot more dispersed. We think that average mean or that mean has a lot of upside still because they're not giving us yet the full credit of the 30%, but it's slowly compounding towards that as we deliver quarter over quarter good results. But it also helped internally. Almost any employee knows what the 60-30-30 is by now, and that helps us to have cohesion on what the vision of the business is from a financial perspective.
Yes, for sure. The 60-30-30 is our main focus at Inter. We can see everywhere we go, everybody's super focused. Now let's talk about the 3 top questions from investors. And starting with the 60-30-30, 30% efficiency ratio is still perceived as a challenging goal. Where are we right now, and how are you going to get there?
So on efficiency, when we announced the 60-30-30, we were at 75. Now we're at 48.8, as we announced in our first quarter results. So we did around 60% of the improvement that we had envisioned in the plan in 2 years and 1 quarter. So we're a bit ahead of that metric. The expense base is comprised of approximately 1/3, which is salaries and personal expenses, and 2/3, which is what we call administrative expenses. Those administrative expenses are comprised on what we call the technology providers, the AWS of the world, MasterCard, Salesforce, etc. On those, we're working very heavily on having more operational leverage, but they tend to grow more or less in line with the business. But the remaining, both salaries and the remaining of administrative expense, is where we have the most operational leverage. We think that those should grow at a fraction of the growth of the revenues. We think that the absence of a distribution network and doing everything digitally allows us to have that operational leverage playing out very nicely. We went very aggressively on cost cutting back in 2023, the year 1 of our 60-30-30. On year 2, we had to recompose a bit of the teams where we need to reinforce some areas of expertise and some talent. And on the other hand, we are also spending or investing a bit more on branding, which is an area where we thought that we would benefit a lot from doing that investment, since it has the power of reinforcing the brand and helping the clients coming to the platform. So we think we had a great 2023. In 2024, we had to reinforce certain teams. By 2025 and onwards, we think it's going to be a smooth ride, improving a few percentage points quarter by quarter.
So in order to get to the 30% efficiency ratio, growth is very relevant. And that's another top question among investors. Talk to us a little bit about how are you going how are we going to continue to grow at this accelerated pace?
Growth is a key area for us. Now, obviously, we want to continue to gain market share. We have been growing the portfolio at 25 to 30% in the last 2 years. We expect to have another year around those levels. Now in 2025, we have certain products that are growing significantly above that percentage. That's FCTS, home equity, and now private payroll as well. We have certain products that are growing close to that average, like for example, credit cards. Are certain products that are a lot more rate sensitive, like mortgages and public payroll, which are growing slightly below that level. But overall, growing at around 25 to 30%, for us, it allows us to continue increasing the credit penetration, increasing the market share, and diluting the expense base. The average loan balance per client at Inter is still a fraction of what it is in incumbents. It's around 1,200, 1,300 reais per active client. Therefore, they're highly under-levered at us, and they still have a lot of financing elsewhere, despite them using Inter as a principal account. So when we look at, for example, public payroll, we have around 30 billion reais of our clients in the system and only 5 billion with us. So we have another 25 billion of share of wallet that we can bring into the system as we convince them that it makes more sense to operate with us as they can operate in an integrated way. So both with the existing clients and the new clients, and with a suite of products that continue expanding now, for example, with private payroll, we think that credit penetration has a very interesting tailwind to continue growing in the rate that we're growing.
And still in growth, the markets in Brazil are very dynamic, especially when we talk about digital credit. Mm-hmm. Private payroll, for instance, is a new product that was launched this year. What are the prospects for this market? How do you estimate this market will reach, and what kind of market share can we gain there?
So private payroll is a product that fits in the middle of the fairway, like the golfers like to say, for Inter, because it's in the Inter by design. We want to provide credit products that are in a win-win situation between the client and Inter. And what do we mean by that? We want to obviously have higher ROI clients that are profitable and help us sustain the growth of the company, but they mainly need to be products that the client can sustain through their life and they are more efficient than the alternatives that they have elsewhere, for example, with unsecured lending, which have rates that are very, very high in Brazil. So private payroll allows the employee to use their future flow of funds to fund themselves at more efficient terms in a fully digital way. So that's exactly what Inter is designed or built to provide. We have started from the very beginning, at the end of March, when the product was launched. We were, and you were as member of the Febraban board, in the discussion board of designing the product. So the day one, 6 a.m., we're there to start operating with it. We're very excited with the beginning that we had offering it. There was a second moment, which is when we were able to operate that through our app. And then in June, there's a third wave when the portability starts. So there are several layers for the product to start scaling up. In terms of TAM, what we think is when we see the market, you have around 300 billion of public in the system, public payroll in the system, in the TAM, and only 40 in private. But you have 3 times more employees in the private sectors, what it's called the CLTs, around 40 million, relative to what we have in the public sector employees. Obviously, the public sector employees have less turnover, so it's easier maybe to have a longer-term credit relationship with the majority of them. But it's still a relationship of 3 to 1 on number of employees, despite the credit being 8 to 1, 300 versus 40 in terms of loan size. So we think that this could be multiple times the current level. There is a consensus of around 200 to 300 billion in the next few years. We think that could potentially be more if we think longer term. But we want to have a meaningful market share. And on the higher market share that we have at Inter is 8% on home equity and 4% of FGTS. 2 other products that are also in the middle of the fairway of the Inter by design, of having very good economics both for the client and for Inter. And this is a third one that would fit in that role. So mid to high single digits is something that we're trying to aspire, in line with what we have with FGTS and home equity.
Okay, and in addition to growth, in addition to credit growth, the other question among the top 3 questions from investors is NIM expansion. So you're growing the credit portfolio, and in addition to that, expanding NIM. Can you tell us a bit about how is the process of NIM expansion? How far can we go?
Excellent. So back until 2022, with interest rates being very low and ample abundance of capital, there was a stronger focus on growth. In 2022, the world changed, interest rates went up significantly, and we placed at the company a much stronger focus on ROE accretive underwriting. We strengthened significantly all of our transfer pricing mechanism with the treasury and the commercial teams, and everything is done now on a marginal ROE basis. And the consequence of that compounding quarter by quarter allowed us to have a very interesting or attractive NIM expansion quarter over quarter of around 20 basis points when we look at the risk-adjusted NIM, which is the one we care the most about. Not just the NIM, but the risk-adjusted NIM, since we have certain products, like, for example, private payroll, which might have slightly more delinquency than public payroll or others, but on a risk-adjusted NIM, it is accretive to the trend. We have been having several layers of several drivers of that improvement. So the first one was the repricing of the back book of mortgages and payroll loans. We had a stock of loans issued before 2022, which were lower yields, and those are being paid off and refinanced at higher rates. So that's driver number 1. Driver number 2 are these attractive secured portfolios like FGTS, home equity, and now private payroll. And then we have the unsecured portfolios like PIX financing and buy now, pay later. We're also very attractive in terms of the NIM. Those are niche products that play certain roles in the ecosystem, but they tend to push NIM up. And last but not least, on the investment portfolio, we have been working also on having returns above 100% of CDI. Now it's close to 110% of CDI. So those 4 levers of NIM expansion have played out in that 20 basis points of NIM expansion. Something we did on the ALM side as well is to match the exposures of CDI on the liability side with the asset side to avoid having surprises or movements in the NIM as a consequence of the changes in the rate environment. If we look at the CDI was 2%, it went to 14.75 for quite some time. Then there was an expectation of going to 9, which changed dramatically at the end of last year when the market was expecting it to go to 15 or 16%, and now people are starting to think that it may go down. So such a big movements in interest rates is something that could impact our NIMs significantly if we weren't hedging it. We want to take that risk out of our day-to-day and focus on the core, which is providing high-quality digital banking services to our clients and letting that volatility not affect the trends that we see in our KPIs.
And credit growth usually leads to a question about capital, capital allocation and capital needs. What can you tell us about the use of capital going forward?
Well, capital links to a prior question. When we talk about NIM expansion, we're also talking about capital allocation. No? So the ROE framework of deploying capital on an accretive way is a decision of optimizing capital. So everything is looked on that basis. We also look at the quality of the ROEs. There are some ROEs that look artificially high because the RWA weight is way too low for some regulatory reason. So we also scrutinize the quality of the ROE as well. But the most important thing is that we're reaching the point of being capital neutral, which is a very important moment for the company. We think that will happen sometime in the second half of this year, which is the moment where we create our own organic capital and we don't consume more of that CET1 through growth. And that's not by decelerating growth, it's just by having higher profitability. We have also issued a subordinated note of 500 million reais a few weeks ago. We think that was another way to optimize our capital structure. We have the holding in Cayman abroad, where we are moving slowly our excess capital from Banco Inter&Co towards there. We think that's very efficient from an overall profitability standpoint. And that was also Inter by design. We pushed the structure to be in that way in 2022 when we relisted or incorporated in Cayman and did the change from B3 to NASDAQ, which was the first of its kind by then. And this capital allocation has to do with that, not to place the excess of capital where it's more profitable, and then within Brazil or within Banco Inter, have that allocated in the most profitable products, always with the core of delivering the best relationship sustainable with the client, which is products that are sustainable from a long-term perspective and that they decrease the overall cost of debt that they have in the alternative products, which are much more expensive.
And in addition to optimizing the capital structure, Inter also has among its competitive advantage a very low cost of funding, perhaps one of the lowest in the industry, that is still below 70% of CDI. Why do we have this huge advantage compared to our peers?
That has to do with the first core product of Inter as a digital bank being the free digital complete account back in 2017. The result of that was that the deposit franchise grew very significantly at the beginning. Then Inter grew more on the transaction and the credit part, but the core from the very beginning was the deposit franchise. It's best in class, it's long tail, highly fragmented. We have around 18 million clients with deposits at Inter. And the question that I've been receiving since I was in your chair as Investor Relations, and I receive it still today, is how long can we have that competitive advantage of a cost of funding in 60% or very close to 60%. And despite the Selic going from 2 to 14 and now moving again, that funding cost continues to be in that level, which is something that we're very proud of. It has to do a lot with that mix and the principality of the client. So if the clients use Inter to deposit their salary and transact from there for their day-to-day transactions, then the cost of funding will likely remain at very competitive levels. And there's a metric that we use a lot, or we look a lot, which is the market share of PIX. We have around 8.3% market share in PIX transactions, which is a testament on how much the clients use our platform to their day-to-day financial transactions.
And shifting to fee revenue, Inter is a super app, a financial super app. The network effect that you mentioned means that there's a lot of cross-sell among the 7 avenues of growth that we have. What is the percentage of fee revenue, and how do you see that ratio going forward?
So we've always operated close to 1/3 of our net revenues coming from fees. That is also a competitive advantage of the company. When we look at the fee income of the Brazilian banks, in general, it's around 15 to 20%. So we are significantly above that level. And it has to do with this platform of financial and non-financial services. We have Intershop, which is the largest e-commerce platform of a bank-owned entity. First of its class launched back in 2019. We have insurance distribution, we have FX, our own investment funds, we distribute third-party funds. We have obviously the cards through interchange. So all of these combo of products have been has been allowing us to sustain around 1/3 of our fees as our source of revenue. That is very efficient from a capital standpoint. Going back to your prior question, it doesn't consume capital, doesn't have cost of risk, and that is something that we like a lot. No, it also protects us from a regulatory perspective by having so much on the fees. There's more regulation typically on the credit side with cap on rates in certain products, and it allows us to have more diversification of revenues, which is something we're very proud of.
Another area of improvement in the last few years has been asset quality. Cost of risk has been reduced consistently. And what is the perspective for 2025, and how do you see cost of risk evolving?
Well, we come from several quarters of having the cost of risk and the NPL ratios improving, and we can see that when we look at the cohorts of the credit cards, the NPLs of credit cards have been improving very, very significantly quarter by quarter. We had some cohorts back from 2020, 2021 where the performance wasn't that great, which is a product, has to do with the fact that it's a product that came later in the sequence of products for us as a company. Remember that around 2/3 of our credit book is collateralized and 1/3 is uncollateralized. That's mostly credit cards. And to the extent that those micro factors, which is the improvement in the credit quality of our own unsecured portfolio, continues to happen, and that's happening as a consequence of strengthening significantly the team, the use of data, both external and internal data, and working on the collection processes as well. That has allowed us to improve the NPL of credit cards and therefore the credit cards of the NPLs of the entire credit book. We think we still have a strong tailwind in that sense. Independently of what happens with the market, we may see some pressure in the market at some time in the second half of this year, but those micro factors allowed us to have this last year or so of decreasing NPLs and cost of risk, which is something that for us is very important. And it has to do also with the essence of Inter being a bank that has a sustainable relationship with the clients. We don't want to have a high risk-adjusted NIM despite having a very high cost of risk. No, we want to have a growing risk-adjusted NIM with a cost of risk that is sustainable for the client and for the company through a healthy relationship. But let me ask that question to you. So from an economic perspective, which is your other hat that you have at the company, how are you seeing delinquency play out in the system and the expectations with the country dynamics throughout 2025?
And the macro scenario is definitely a bit more challenging this year. When you reach this level of a Selic rate closer to 14%, it means that we will see some deceleration in the economic activity going forward. We might see some softening of the job market. So it's a scenario that we should be more cautious about credit quality. The market may show some numbers that are a bit worse in terms of NPLs going forward. But not significantly. It's a deceleration that should be kind of organized. But yes, it's a more challenging scenario this year than we have seen in the past. But despite being in a macro scenario that is more challenging, it's very exciting to see numbers at Inter and to see the delivery of the strategic plan that we designed, and a lot of opportunities coming ahead. What would be your final message for our investors looking into 2025 and 2026?
Well, we couldn't be more excited of the prospects of the business. We're at the very beginning of a journey which is very exciting. We have the management team, we have the balance sheet, we have the clients, and we have the experience to continue delighting the clients with a very differentiated value proposition, which is the financial super app. What we see is that the products that we are launching are being adopted at a higher pace. And we have this slide, which we call the millionaire slide, how many clients reach 1 million and how fast they do so. And we see that accelerating and achieving that threshold in less than 6 months by now. So that is a source of, for us, validation of what the business model being very strong. We think that this year is going to be a critical year for us, for a very important year, to show that we're reaching ROE levels that are above our cost of capital, and at the same time our clients continue to come into the platform of at least 1 million new active clients per quarter, which is also a testament of the quality of the franchise and how appealing it is for our clients.
Thank you so much, Santi, and thank you everyone for listening. See you next time.